percentage of total market cap relative to the U.S. GNP, which you have said is probably the best single measure of where valuations stand at any given moment. This indicator is at about 125%. The second indicator is corporate profits as percent of GNP. Are the current levels of either one or both of these indicators a matter of concern for the general investing public?
It might be the second figure, which is the profits as a percentage of GDP, might be a concern for other segments of society, because what it indicates is that American business has done wonderfully well in recent years, and though it says what a terrible disadvantage it has because of U.S. tax rates and a host of other things, the facts are that American business has prospered incredibly. And the first comparison is very much affected by the fact that we live in an interest rate environment which Charlie and I probably would have thought was almost impossible not too many years ago. And obviously, profits are worth a whole lot more if the government bond yield is 1% than they're worth if the government bond yield is 5%. And so it gets back, and Charlie in that movie talked about alternatives and opportunity cost. And for many people, the opportunity cost is owning a lot of bonds, which pay practically nothing, or owning stocks, which are selling at fairly high prices historically, but they weren't selling at those historic prices with interest rates like this. So I would not, I look at those numbers, but I also look at them in the context of the fact that we're living in a world that has incredibly low interest rates, and the question is how long those are going to prevail. Is it going to be something like Japan that goes on decade after decade, or will we be back to what we thought was normal interest rates? If we get back to what are normal interest rates, stocks at these prices will look pretty high. If we continue with these kind of interest rates, stocks will look very cheap. And now I've given you the answer, and you can take your pick. Charlie?
Well, since we failed to predict what happened and what exists now, why would anybody ask us what our prediction is in the future?
Yeah. Incidentally, the one thing I can assure you, Charlie and I, to my knowledge or my memory, I can't recall ever us making an acquisition or turning down one based on macro factors. That and we talk about deals when they come along, but whether it was See's Candy or whatever it might have been, the Burlington Northern, we bought at a terrible time, general economic conditions. But we don't talk. It just doesn't come up because we know we don't know what the next 12 months, 24 months, 30. We know we don't know what that's going to look like. But it doesn't really make any difference if we're buying a business to hold for 100 years. What we have to do is figure out what's likely to be the average profitability of the business over time and how strong its competitive moat is and that sort of thing. So people have trouble believing that. They think we talk about it. We think any company that has an economist, certainly has one employee too many. Charlie? Yeah. Did you think of anything rude to say that I haven't said?
Well, it would be hard to top that one.
Okay.
Do you think the new rules strike the right balance between efficiency and safety? For Berkshire, what impact will these new rules have on the operations of Marmon's Union Tank Car subsidiary and on the BNSF Railroad? Can you also update us on the BNSF initiative to purchase up to 5,000 of its own oil tank cars, which is a departure from historic industry practices?
You've asked all the questions I'll be asking, but I think those rules just came out, 2 days ago now? Yeah, and they're 300 pages. And little as I have to do with this meeting and everything, I have not read those, although I've talked very briefly to Matt Rose about them, and also Frank Patak, who runs the company that manufactures and leases tank cars. Our interest, actually the interests of our railroad and our tank car manufacturing and leasing operation may diverge in various ways. Clearly, we've got an interest, the country has an interest in developing safer cars, and we found that some cars we thought were safe have turned out to be less safe than we thought going in. The most dangerous kinds of things we carry, of course, as a common carrier, we have to carry chlorine, we have to carry ammonia, and we're required to carry that. We'd rather not carry it. There are dangerous products that have to get transported in the country, and it's more logical to transport them by rail than either truck or pipeline. And some of those we'd rather not carry, but we do carry. I would say that probably everybody will be somewhat unhappy with the rules, but it is up to Washington and the government to devise the rules under which something that is potentially dangerous is transported. And transporting by pipeline has its problems. Transporting by rail has its problems. And railroads have gotten dramatically safer over the years. Our safety figures, and Burlington Northern leads the industry in safety. But the safety figures get better year after year. But you're going to have derailments, and you better have very safe cars carrying that, and nothing will be perfect. Charlie?
Yeah, well, big companies and successful companies like Burlington Northern and Exxon and Chevron and so on have a lot of engineers, and they have long histories of trying to be way safer than average and knowing a lot about how to do it. And none of that is going to change. You'd be out of your mind to own these big companies and not run them with a big attention to safety. And we're not out of our minds, and neither are the people who run Burlington Northern. The safety is going to be improved continuously, and should be.
Yeah, and it has been consistently, but
yeah.
But there are new problems. For one thing, the Bakken crude has proven to be quite a bit more volatile than most of the crude that is.
Well, it's not really crude; it's condensate. I mean, it's almost misnamed. Call it crude. It is more volatile.
Yeah. I can tell you, and I may write about this next year in the report, though, that Burlington Northern has the best safety record among the big railroads. And Berkshire Hathaway Energy, it's extraordinary, their safety record in terms of utilities. And every utility we purchased at Berkshire Hathaway Energy, we brought the safety statistics. They've gotten far better after Greg Abel has taken over.
After they bought the Omaha pipeline, which had been mismanaged and safety had been improperly ignored, we watched those people, the Berkshire employees, just work day and night improving the safety. They didn't want more pipeline explosions.
Yeah, we went from last out of 40-some, I think it was, to either second or first. And if we were second, it was because our other pipeline was first.
What advice would you give to someone who's trying to network with influential people but doesn't have access to the alumni network of a top business school?
Let me take that one. I think you should do the best you can. Playing the hand you've got.
Charlie's very Old Testament on this. Didn't get much past Genesis. If it was his question that he didn't have a lot of associations because
he'd like to have you help him
tap into
do well without business school training. I never had any business school training. Why should you have any?
Yeah. And actually, I would say the business school training, particularly in investments, was a handicap about 20 years ago when they were preaching efficient market theory, because essentially they told you it didn't do any good to try and figure out what a company was worth because the market had it priced perfectly already. Now, imagine paying $30,000 or $40,000 a year to hear that.
Yes. You were very lucky to avoid a lot that you've avoided.
How do you feel about your law school training, Charlie, while we're on it?
Well, I have a son-in-law who recently explained how modern profit-obsessed law firms work. He says it's like a pie-eating contest, and if you win, you get to eat a lot more pie.
How would a worst-case scenario, perhaps one in a more urban area or a BP-type accident, impact BNSF and Berkshire Hathaway? And is the company insured or protected against such losses?
Our insurance, reinsurance unit actually went to the 4 major railroads offering very high limits. I think this is from memory. I could be off on this somewhat, but I think we offered something like $5 or $6 billion excess of maybe $1.5 billion or something like that to the railroad retained. So there's no question about it. If you had the exact wrong circumstances, a train with a lot of ammonia or chlorine or something, right in some terrible urban area, the possibility always exists that can happen. It can happen. You can have plane crashes. There are things that are very small probabilities, but if we run trains millions and millions of miles, year after year, something will happen, just like they happen in every other possible accident way. And so you minimize it. You run trains slower in urban areas. They've already instituted that with crude. I think they brought it down to 35 miles an hour in towns of 100,000. That's the maximum. So that you're always working to be safer. You'll never be perfectly safe. We do not. We have some insurance at Burlington Northern, but we don't need insurance at Berkshire. We've got the capability to take any loss that comes along. So we actually would be more likely to be offering that insurance, and we did offer that insurance, and the railroad industry didn't like our rates, which is understandable, and so they haven't bought it, but that doesn't mean they won't at some time in the future. I should add one thing I forgot to say to Jonathan. I don't think we will be buying the 5,000 rail cars. I think I don't know that for sure, but there's going to be a lot going on in terms of retrofitting. Our Marmon operation has actually taken on a new facility that will be working very hard. Once we know what the retrofit requires, we will be, I'm sure, working 3 shifts on retrofitting cars. Probably our own, probably some other people's. We'll be building new cars. The industry has been waiting to see what the requirements would be before moving ahead. The first quarter of 2015, there were practically no tank cars ordered. There's a backlog, but there's no tank cars that were ordered because we need to see what the regulations are. But we'll be very active in retrofitting and in manufacturing new cars. But I don't think we'll be. Historically, the railroads have never really owned tank cars. That goes back to the Rockefeller days. And I think the present method of having car lessors, such as the one we own, I think will continue in the future rather than having the railroads own them.
I have a question on intercompany transactions within the insurance companies. What is the main purpose of all those movements? What financial flexibility might it provide you, and why now?
Yeah, well, there are a lot of things at Berkshire that the why now is can be answered by the fact, well, we just got around to it. The huge chunk of capital in the insurance companies is at National Indemnity. So we have moved through these quota share arrangements. We've moved premium volume that is generated at Geico or MedPro or different companies. We move that up to the parent because that's where there's just extra layer after extra layer after extra layer of capital there, and that it makes it a little simpler that way. It makes it a little simpler just in keeping all the money invested, and as opposed to having 50 pockets or 75 pockets to look at it. If you have a couple of main pockets to look at it, there's no real change in the certainty of payment of policies or anything of the sort. It really makes life a little easier in terms of managing the money by having most of the funds concentrated in national indemnity. So there's no mastermind to it. We ended up with a few companies in Geico Corp, which was a holding company for Geico itself, and it just seemed that we probably ought to get those up to the parent company level, and we put them there. But our general approach is just to keep every place loaded with more capital than anybody could possibly conceive of us needing, and that's going to result more and more probably in the funds being concentrated in national indemnity.
The U.S. is not a prospective founding member of the Asian Infrastructure Investment Bank, where many European countries are. The AIIB is relatively small, but if this is part of an ongoing trend in the next 50 years, how will that impact the U.S. multinational corporations?
Well, that's a subject I know absolutely nothing about, so let's hope Charlie does.
I know a little less than you do.
I really apologize to you in terms of your question, but if we started talking about it, we'd be bluffing. Yeah. You have a second question?
How about the dollar as a reserve currency? Do you have any issues or concerns in the next 50 again?
I think the dollar will be the world's reserve currency 50 years from now, and I think the probabilities of that are very high. Nothing certain, but I would bet a lot of money on that one. Charlie?
Well, I have a little feeling on that subject. I'm probably more nervous than a lot of people about printing a lot of money and spending it. There are times when you have to do it, I'm sure, and we just came through one. But I'm happier when we print money and use it improving infrastructure than I am when we just spread it around with a helicopter.
So what do you think is going to happen if we keep spreading it around with a helicopter?
I think it's always more dangerous than the economic profession thinks.
Recently, several subsidiaries were renamed to include Berkshire or BH in their name, which Mr. Buffett has avoided doing previously, at least due in part, I imagine, to increased reputational risk should something go wrong. Can you discuss how you decide which subs are allowed to rebrand? Will Fruit of the Loom become Berkshire Undergarments?
Well, if it does, we won't pay him a royalty for the idea. We did create a Berkshire Hathaway home service operation, which is a franchise operation. We bought 2/3 of the Prudential franchise operation a couple of years ago, and we have a contract where we can buy we'll buy the remaining third in another couple of years. And so we were going to lose the rights to Prudential over time. And Greg Abel asked me about using Berkshire Hathaway, and I told him that they could use it, but that if I started hearing of any abuses of it or anything of the sort, we would yank it. And that maybe that would be a useful tool in making sure that people behaved like we wanted them to. And so far that's worked out fine. We've had no idea that we wanted to take Berkshire Hathaway into becoming a household name and that would create extra value. But we were going to rename a large franchising operation, and like I say, as long as the name does not get abused, that'll be fine. And the Van Tile Auto, we're calling that the Berkshire Hathaway Automotive Group. Certain of the dealers will have the right to use that as a tagline and others won't. And again, if there's problems connected with it, we'll change it. But in a sense, that isn't bad. If there are going to be problems, I just soon hear about them. And if I hear about them, because the name is Berkshire Hathaway, it may mean that I get on top of them faster than I would otherwise. We have a good many of our companies at the bottom of their letterhead or something of the sort, they say a Berkshire Hathaway company, and that's fine. But we do not anticipate that we're going to turn it into some huge asset by branding a bunch of products that way. Charlie?
Well, we'd be crazy to try and sell Berkshire Hathaway peanut brittle instead of See's. Those old brand names are worth a lot of money.
Now that Elon Musk has joined the fray this week with his idea of batteries for the home for his new Tesla energy initiative, which could lead the way for larger systems for business use, and realizing that disruptive technologies can at times upend an industry's business model and competitive positioning, how long do you believe it will be before distributed generation becomes a meaningful threat to your utilities, especially if power can be stored more easily at the end user's place of business or home?
You put your finger on storage being the key. And Charlie follows storage a good bit more than I do, and maybe I'll have Greg Abel talk about it. But obviously, distributed energy is something we pay a lot of attention to. One of the probably the best defense is to have very low cost energy, and Mid-American's done a terrific job in that respect. And the figures in terms of people who have adopted solar in our territories are just minuscule, and to stay that way. But huge improvements in storage would make a difference in a lot of ways. And Charlie, what are your thoughts on that?
Well, obviously we're going to use a lot more renewable energy because the fossil fuels aren't going to last forever. And obviously Berkshire is very aggressive and very well located in terms of this development. I grew up here in this part of the world, and to have 20% of the power of Berkshire Utilities in Iowa coming from the wind, I regard as a huge stunt. And it's, of course, very desirable in a windy place like Iowa, where the farmers like the extra income, to be getting a lot of power out of the wind. And, of course, we're going to have a lot better storage, and the technology has been improving. And it's not a threat, it's a huge benefit to humanity, and I think it'll be a huge benefit to Berkshire. I mean, everything is working for us. I love owning Mid-American in an era when we're going to have more storage, more wind, more solar, more grid. And I think we're so lucky. What the hell would we do as the fossil fuels run down if we didn't have the sun to use indirectly in these forms? And of course, there's going to be a lot more storage, and of course there'll be some disruption in the utility industry, but there'll be more opportunity, I think, than disruption.
Just in the last week, we've announced we're already the leader, and we've announced two different projects, one in Nebraska. I think it's 400 megawatts in Nebraska. That'll be the first time we've had a wind farm here. And then we just got approval in the last couple of days for, I think, $1.5 billion worth more of wind in Iowa. And I think Charlie mentioned 20%, but if Greg Abel could take the microphone, I think it's a lot greater percentage than that now. It's a moving target, so I may not have kept Charlie posted on the number. But Greg, would you bring people up to date on what percent we will be in Iowa when the present projects are completed, and also what has happened in Nevada and a few places like that? Greg?
We announced our 10th project in Iowa. That brings us to more than 4,000 megawatts built over the last 10 years in that state. And at the end of 2016, we will now have 58% of our energy, approximately 58% of our energy that we provide to our customers coming from wind. We now have more than $18 billion committed to renewable assets across our different utilities. And if you look at NV Energy, our Nevada utility, for example, we've committed to retire 76% of their coal by 2019, and a large portion of that will be replaced with renewable energy. So clearly a continued commitment to that.
In our utility business, do you think we have more disruption to fear or more opportunity to love?
Yeah, distributed generation and solar bring great opportunities for all of our different utilities, and we'll embrace it.
The answer is you couldn't be luckier, is what I'm telling you.
One thing that has helped in this respect is that wind and solar, the development of wind and solar at present, are dependent on tax credits. In other words, the federal government's made a decision that the market system would not produce solar or wind under today's economics, but it has an interest as a society in developing it, so they have established a credit. I think it's electric is 1.9 cents a kilowatt for 10 years. And because Berkshire Hathaway Energy is part of the consolidated tax return of Berkshire Hathaway Incorporated, it has been able to invest far more money than it would make sense to invest on a standalone basis. Among electric utilities in the United States, there's really no one situated as well as Mid-American Energy is, because it's part of this consolidated tax return, to really put its foot to the floor in terms of developing wind and solar. So it's become the biggest developer by far among the utility industry, and I think it's very likely to continue to be, simply because most utilities really don't pay that much income tax, and therefore they're sort of limited in how far they can push development of wind and solar.
What was your most memorable failure, and how did you deal with it?
Well, we've discussed Dexter many times in the annual report, where I, back in the mid-1990s, I looked at a shoe business in Dexter, Maine, and decided to pay $400 or so million for something that was destined to go to zero in a few years, and I didn't figure that out. And then on top of that, I gave the purchase price in stock, and I guess that stock would be worth, I don't know, maybe $6 or $7 billion now. It makes me feel better when the stock goes down because the stupidity gets reduced. Nobody misled me on that in any way. I just looked at it and came up with the wrong answer. But I would say almost any time we've issued shares, it's been a mistake. Wouldn't you say that, Charlie?
Of course.
Yeah.
We don't do it much anymore.
No. We probably could have pushed harder, particularly in the earlier years. We've always been, we've had all of our own net worth in the company. We've had all our family's net worth, and we've had all these friends that came out of our partnership, many of whom put half or more of their net worth with us. And so we've been very, very, very cautious in what we've done, and there probably were times when we could have stretched a little and pulled off something quite large that we made a mistake looking back. But I wouldn't want to take a 1% chance, of wiping out my Aunt Katie's net worth or something. It's just not something in life that I could live with. So I would rather be 100 times too cautious than 1% too incautious, and that will continue as long as I'm around. But people looking at our past would say that we missed some big opportunities that we understood and could have swung if we'd wanted to go out and borrow more money. Charlie?
Well, it's obviously true. If we had used the leverage that a lot of successful operators did, Berkshire would be a lot bigger.
A lot bigger.
A lot bigger. But we would have been sweating at night. It's crazy to sweat at night.
Over financial things.
Over financial things, yes.
Well, we won't pursue that.
And if high rates of inflation did occur, how would the consequences for Berkshire compare to those for most large companies?
So far, we've been very wrong, or I've been very wrong. Charlie's probably been a little bit wrong, too.
Of course.
Yeah. No, I would not have predicted that you could have 5 or 6 years of close to zero rates and now get negative rates in Europe and run fairly large deficit, although the current deficit is not that large. I mean, the country could sustain on average 2 or 2.5% deficits forever and not increase the ratio of debt to GDP. So the word deficit is not a dirty word, but very large deficits and sort of uncontrollable are scary. But we've taken the Federal Reserve balance sheet up from $1 trillion to over $4 trillion, and we've done a lot of things that weren't in my Economics 101 course, and so far nothing bad has happened except for the fact that people who saved and kept money in short-term savings instruments have just totally gotten killed in terms of their the income that they receive from that. But it's still hard for me to see how, if you toss money from helicopters, that eventually you don't have inflation. Certainly if the money supply grows faster and faster relative to the output of goods and services, something like that is supposed to happen. But I've been surprised by what's happened. When Poland issues bonds at a negative interest rates, I did not have that on my list of forecasts a few years ago. And so I think we're operating in a world that Charlie and I don't understand very well, and to the second part of the question, I think Berkshire, in almost any kind of environment, will do better than most big companies. I mean, we are prepared for anything. We'll always be prepared for anything. And if we see really unusual opportunities, we're also prepared to act. And that gives us a real advantage over most big companies. We don't count on anybody else. We're sitting with over $60 billion right now. I'd rather be sitting with $20 billion and have made a great $40 billion acquisition. But we will be very willing to act if economic turbulence of any kind occurs, and we'll be prepared, and most people won't be. Charlie?
Yeah, we have made very little progress in life by trying to outguess these macroeconomic factors. We basically have abdicated. We're just swimming all the time, and we let the tide take care of itself.
And we really we've not seen great successes by others who have been all involved in macro predictions. I mean, they get a lot of airtime, but that's about all that happens.
The trouble with making all these economic pronouncements is that people gradually get so they think they know something. It's much better just to say I'm ignorant.
Yeah. We will find things, though, under any circumstances. They don't come in an even flow. They may not, and you can't predict the size or anything, but you can be sure that over the next 10 years, you'll see a lot of things you didn't think were possible, and we will occasionally see something that makes sense for Berkshire, and we will be prepared to do it both psychologically and financially.
Do you consider any portion of the cash flow from annual increase in deferred taxes to be economic earnings? Is this a sustainable dynamic, or do you expect the relationship between cash and reported taxes to ever flip, for instance, if bonus depreciation ever expires? Given Berkshire's massive appetite for capital spending at the utility and the railroad, is it possible instead that its deferred tax liability will never have to be paid no matter what Congress does with bonus depreciation? And is it perhaps even likely that this form of float will continue to grow?
Probably the most likely answer, there's two forms of it, float from deferred taxes. One is the unrealized appreciation on securities, and there, who knows what happens. I don't think the appreciation is going to disappear, but we may decide to realize some of it from time to time. In fact, we could realize a lot of it. If you move over to the depreciation, which you're talking about on the $37 billion, because the total deferred taxes, as I remember, up maybe $60 billion or something like that. That is a factor of accelerated depreciation. And one form or another of accelerated depreciation has been around a long time. Occasionally, I think the bonus depreciation one year went to 100%. I could be wrong on that. Certainly in our utility business, that helps our customer and it doesn't help us, basically. I mean, we will get a return on equity, and that's not free equity to us or anything of the sort. The regulatory commissions take that into account. Return on invested capital in terms of how the Surface Transportation Board would look at it, again, I don't think we benefit enormously by that. It does mean there's less cash going out the door, and we therefore don't need to borrow as much money for capital investment as otherwise. But I don't think I would look at that as a hidden form of equity. I'd rather have the deferred taxes than not have them, but it's not meaningful there. Now, what could happen is that overwhelmingly those deferred taxes were probably entirely, even to the extent they're in the United States, were accrued at a 35% rate. So if the corporate rate changed, then you would have a major change in the deferred tax item. And there's always a possibility of that.
But it would be a book entry. It wouldn't mean much.
It wouldn't mean much, yeah. We do the float from the insurance business we regard as a terrific asset. The deferred tax liability is a plus, but it's not a big asset.
I was wondering if you could talk about Henry Singleton's Teledyne and whether you learned lessons from that, used it as a model, and what you think about how it ultimately unwound and how you might want Berkshire to continue differently.
Yeah, that's a very good question. And Charlie knew Henry Singleton. I knew a lot about him. I mean, I studied him very carefully, but Charlie knew him personally and as well as studying him. So I'm going to let Charlie answer that. But there's a lot to be learned from both what Singleton did in his operating years and then what happened subsequently.
Henry Singleton was very interesting. He was a lot smarter than either Warren or I. Henry was the kind of guy that always got 800 on every test and left early. And he could play chess blindfolded at just below the grandmaster level when he was an old man. That said, I watched him invest and I watched Warren invest, and Warren did a lot better. He just worked at it. Henry was thinking about inertial guidance and Warren was thinking about securities, and the extra work enabled Warren to get by with his horrible deficit of IQ compared to Henry. And the interesting thing about...
Let's not quantify it.
No. The interesting thing about Singleton is he had very clever incentives on all the key executives. And they were tough, and they were important, and they were meaningful. And in the end, he had 3 different Defense Departments that got into scandals. He wasn't doing anything wrong. He wasn't trying to hurt the Defense Department on purpose. But the incentives got so strong, and the culture of performance got so strong that people actually went too far in dealing with the government. Teledyne did. And so we haven't had any trouble like that I know of. Can you think of any, Warren?
No, and Charlie and I, we really believe in the power of incentives. And there's these hidden incentives that we try to avoid. One, we have seen, both of us, more than once, really decent people misbehave because they felt that there was a loyalty to their CEO to deliver certain numbers because the CEO went out and made a lot of forecasts about what the company would earn. And if you if you go and say, if I were to say that Berkshire is going to earn X per share next year, and we have a bunch of executives in the insurance business that set loss reserves and do all kinds of things, or companies in other areas that can load up channels at the end of quarters, at the end of years. I've seen a lot of misbehavior that actually doesn't profit anybody financially, but it's been done merely because they don't want to make the CEO look bad in terms of his forecast, or he's done it because he doesn't want to look. When they get their ego involved, people do things that they shouldn't do. And so we try to eliminate incentives that would cause people to misbehave, not only for financial rewards, but for ego satisfaction. And I think that's probably pretty unusual to even be considering that in the business, but we've seen enough, so we do consider it.
I might also report that at the end, Henry wanted to sell his business to Berkshire for stock. So he was very smart of him, right to the very end. We had a case at National. It's interesting. You really have to should understand human behavior and if you're going to run a business, because when National Indemnity, we're going back to the late 1960s, Jack Ringwalt was a marvelous man. He ran it, and he had another marvelous man who worked for him as his tennis partner, and that fellow was in charge of claims. And when the claims man would come into Jack and say, I just received a claim for $25,000 or something for some long-haul truck or something, Jack would say, it was just his personality. He would start berating the fellow and saying, how can you do this to me? And these claims are killing me and all of that. And he was joking. But the fellow he was joking with couldn't take it really, and he started hiding claims. And he stuck them in a drawer. And that caused us to not only misreport fairly minor figures, but it also caused us to misinform our reinsurers because they had an interest in the size of claims. And the fellow that was hiding the claims had no financial interest in doing it at all, but he just didn't like to walk into the office and have Jack kid him about the fact that he was failing him. And you really have to be very careful in the messages you send as a CEO. And if you tell your managers you never wanted to disappoint Wall Street and you want to report X per share, you may find that they start fudging figures to protect your predictions. And we try to avoid all that kind of behavior at Berkshire. We've just seen too much trouble with it.
If government regulators deem Berkshire Hathaway's reinsurance business too big to fail, how would government regulation of the reinsurance business affect Berkshire Hathaway?
There's two essentially regulatory aspects to it. One is there's a European, and I hope I'm describing this right. I may be wrong a little bit on some technicality. There's a European group that is looking at insurers generally and has designated, I believe, 9 or so insurance companies as, I'm not sure what they call them, but they deserve special attention, I'll put it that way. There's a technical name for it. The one that's more relevant in the United States is the Financial Stability Oversight Committee, I believe they call it, which designates so-called SIFIs, systemically important financial institutions. And large banks are in that category. And then the question is what non-banks are in it. And they designated General Electric and Prudential and recently Metropolitan, and Metropolitan is fighting the designation. The question is question isn't just whether you're large. I mean, ExxonMobil's large, Apple's large, Walmart's large, and nobody thinks about them as SIFIs. The definition on a non-bank SIFI would be 85% of revenues coming from financial matters, and we don't come remotely close on that. I mean, we're 20% or thereabouts. But the real question is whether problems that Berkshire might encounter could destabilize the financial system in the country. And we have not been approached. Nobody's ever called me. They spent a year with Metropolitan even before they designated him. So we have no reason in logic or in terms of what we've heard to think that Berkshire would be designated as a SIFI. I mean, during the last time of trouble, we were about the only party that was supplying help to the financial system, and we will always conduct ourselves in a way where the problems of others can't hurt us in any significant way. And I think we're almost unique among financial institutions in the layers of safety that we've built into our system in terms of both cash and operating methods and everything else. It's a moot question. The law exists. We haven't been approached about it, as I mentioned. Apparently, it takes a year or so, even if they approach you, while they listen to your presentation and look at your facts. And I do not think Berkshire Hathaway comes within miles of qualifying as a SIFI. Charlie?
I think that's true, but I think that generally speaking, there is still too much risk in a lot of high finance. And the idea that Dodd-Frank has removed it all permanently is nonsense. And people like hanging on to it. You know, trading derivatives as a principle, if you're shrewd, is a lot like running a bucket shop in the 20s or a gambling parlor in the current era. And you have a gambling parlor that you have a proprietary edge in, and you say it's sharing risk and helping the economy and so forth. And that's mostly nonsense. The people are doing it because they like making money with their gambling parlor, and they like favorable labels instead of unfavorable labels. So I think there's still danger in the financial system, and I also think our competitors don't like it that they deserve regulation and we don't. And I think there's danger in that too.
Yeah. One thing that may not be, I haven't read much about it, but my understanding is that Dodd-Frank actually weakens the power of the Fed and to some extent the Treasury too, to take the kind of actions they took in 2008 primarily. And those powers were needed to keep our system, in my view, from really going into utter chaos. The ability to say and have people believe you when you say it, that whatever needs to be done will be done, has resided in the Federal Reserve and with the central bank, the European Central Bank. And the fact that people believed when Hank Paulson said that the money market funds are going to be guaranteed, that stopped a run on $3.5 trillion of money market funds that had lost $175 billion in deposits in the first 3 days there back in September of 1 week. If people hadn't believed that, you would have seen that $175 billion turn into $1 trillion very quickly. I mean, the system would have gone down. So when you have a panic, you have to have someone somewhere who can say and be believed and be correctly believed that he or she will do whatever it takes. And you saw what happened in Europe when Draghi finally said that, and you saw what happened in the United States when Bernanke and Paulson more or less together said it. And if you don't have that, panics will accelerate like you cannot believe. In the old days, the only way you could stop a run on a bank was basically for somebody to come and pile up gold. I mean, they used to race it to the branches that were having a problem. I remember reading the history of the Bank of America on that and how they would put out runs before the Federal Reserve existed. And the only thing that stopped it was to pile up gold. I mean, if the CEO of the bank came out and said, our Basel II ratio is 11.4%, the line would just lengthen. It would not get the job done. Gold got the job done. Bernanke and Paulson got the job done. But the only way they got it done was saying, we're guaranteeing new commercial paper. We're guaranteeing that the money market funds won't break the bank. We're going to do whatever's necessary. I think Dodd-Frank weakens that, and I think that's a terrible thing to weaken.
You have started a direct workers' comp operation online, bhdwc.com. It looks a little bit like you're Geicoizing some of the commercial lines. What's the overall strategy, and what concerns might you have on channel conflict?
Well, Progressive did pretty well with channel conflict between direct writing and agents. We will find out what the consumer wants, but we are experimenting with online workers' comp. As you can tell, we've done pretty well with online direct auto over the years. We'll find out. I don't think the channel conflict is a big problem for us. It might be a bigger problem for some other companies, but I don't think that's a big problem. And it's a trickier thing. We write commercial auto through Geico, and that's grown, and it's not small, but it hasn't achieved private passenger auto proportions.